this material is not, for the most part, it's not numbered mercury, but there's some, and it isn't there. You might have noticed. Let me get this back up again. A few minutes of this.
We probably will.
Okay, did I spell my name wrong there?
Okay, Rich. Oh, there's a space between that.
For God's sake. Why you can't remember who I am is beyond me.
Oh, I've been thinking about that. And if you think of, there's like computers at the serve that we have to log into. So it couldn't always just, like you would have to keep logging off and logging back in for people to like do employment hours for on-job things. So that's why I couldn't just remember you. Because then it
Because
would.
different people use it. Yeah, I knew that. Different people use this one too. What are you wrong? Right, we did. I want chapter. What are we doing? An easy class. Yeah, good. What slide were we on? Anybody remember?
Yeah. During the weekend.
You think it's actually opening? Yeah, there it goes. Tells us it's true. 26.
I don't know. Could be.
No.
No.
Did we do current assets and stuff yet? No. We had just done it. We only done a few. They were 15 or so.
Let's just start with the beginning and keep going until we
Balance sheet, current assets. Okay, we looked at this, I think. Yeah, restricted securities and unrestricted. We did that. Okay, so we're around here somewhere. Yeah, we did this one, remember?
Yes.
What are we talking about? So, you know, the bad thing about intermediate accounting is you have to sort of get everything you do in principles back really fast. Found that out for the chapter 3 quiz. But it's still true with 4 and 5, only it's in more depth than we did in principles, but it's really the same stuff, isn't it? So, you know, we talked about health maturity, though. Are these things real fresh for you, coming out of principles? Did you handle accounting for, you know, a bond, premium, discount, amortization? You know, you want to be able to do that. And we'll do it again in another class, B12, I think that comes in. But, you know, the better you know it as you go, the better off you are. So we touched on it a bit here, and then we'll touch on it a lot more there. We'll go in depth, okay? And real soon we're going to get into, the next chapter is going to be present values, future values, annuities, due, and ordinary annuities. And most of you will think, George, you know how to do all that stuff? Let me assure you, you don't. The problem is that you won't be able to figure out when we get the cash exactly, and how much cash exactly, and what the discount rate should be exactly, right? So they're going to be more real, let's put it that way. And then immediately following that, we're going to do weighted average cost of capital, capital asset pricing model, and we're going to be coming up with our own discount rates, right? And our own estimates of cash flows, and we're going to be valuing companies that way. So what we did in principles was sort of the tip of the iceberg, okay? So if you have a really solid how to do present values and future values, and also be able to handle annuities, which is no big deal, right? And by the way, if that isn't real fresh, we'll fix it, okay, real fast, okay? So it'll come back. Get into working with that stuff, career-wise or anything. Okay, so it's the way we do it. Everything is worth the discounted present value of its future cash flows. I'll be run over today, so you guys. Okay, that's our records morning. Real close up. Right up here on this road.
You watched that?
Well, yeah. I was stopped. I was going to turn on, what is that street, right up by the park up here, Powder Park. No, this way. This way. You go right up the hill, at the top of the hill. As you start back down the other side past Eastern. There's a little road goes up to the side, it goes over to Barrett. Anyway, this kid, I was parked there, I was going to turn and go over to Barrett, go down to the meeting. And then there's a lane beside me going straight. Well, the guy in the lane beside me had gone straight, and his stop line's a little further up. So he was about half car behind me. just right in, and not very fast. Just ran into him, and so the guy's front end is all messed up. Both cars' front end is messed up. And then he kind of turned, he knocked apart, and he turned and started driving down the hill and then back up the hill, barely moving, like the car was just idling. And then he stopped. So I went up to him. I saw the first one was fine. It was right next to me. And I went up to him. No airbags. His car engine was new. And this kid had this really old car, and had passed out and just had driven up the road. So he hit his chest, hit his head, and so I called 911. And we got, they were having an ambulance come. The police came and stuff. But it's really, wow, really difficult, strange. So be careful about it. Yeah, it wasn't slick or anything. I don't know what happened. Maybe he passed out. He was on his way to work. He said he came around before the police came. He said, and then he was fine. Seemed to be, other than his chest hurt. So it was an eventful morning. So it was like my 81st day. I was in this room, but had a good excuse for anything. So anyway, yeah. I don't know why I told you about that.
Like a good Samaritan.
Huh? Yeah, yeah. Be a good Samaritan. Yeah. But I have warning flashers. I can stop and do warning flashes. Call 911. Can't do anything else for the guy. But anyway, nice kid actually. So, all right. CBD. Unfortunate warning. His car is totaled. I bet he can't afford a new one. The junkie. So, anyway, probably for a sale. So anyway, you need to know those things, of course. All right, so here's some short-term investments, just ways that you would record them. So read this chapter really carefully, look at all the different ways. You could go look at some real financial statements if you want. And then I'm going to give you, imagine, two ways I could do this. I can give you a list of a whole bunch of accounts. I like to do this because they're relatively easy to grade, I guess. And I think they test it. What section does it go in, right? Does it go in current assets, non-current assets? Does it go in investments? Does it go in other assets? Does it go in current liabilities, non-current liabilities, equity section? Where do accounts go? Okay? And I'll try to come up with the most unusual names I can possibly find. So read some financial statements, look at it, see what's in the book, study it real carefully. Okay? You need to know what these things are. So anyway. And then we'll do the same thing with the income statement. Where do they go? Right? Where do you put things? And what would the disclosures look like? Another way I could do it, and this is really popular on the CPA exam, so I'll probably do it either on a test, quiz, or final somewhere, quiz, test, final. I'll give you a financial statement that's messed up, and I'll ask you what's wrong. And what I would suggest with that is that you prepare a perfect one, and then go through every change you made, because otherwise you won't find them all probably. Things are in the wrong place, and you'll be drawing arrows back and forth or writing a narrative, and it's a pain for you and a pain for me. Much easier. If you're doing the CPA exam, I already tell you this. They give you a statement that's screwed up. You make the statement perfect, and then you start talking about it. They'll never read what you had to say. They'll just look at the statement and say, that's perfect. 10 out of 10 or whatever number of points on the question. Of course. Because why would they read everything you had to say? You knew exactly what you were doing. So I think a really nice strategy. But then still give them the narrative. Don't just do the statement. If they say to prepare a correct statement, you do. If they say to comment what's wrong with this statement, then prepare a corrected one, and then comment. Go through line by line and say this change, why? Why did it look like this? Those are the two basic ways. It's really hard to test on this stuff. The other thing I could do, of course, and could, this would be more in a test, I could give you all the accounts and ask you to prepare financial statements. Like that little one that I had you do on the first test, only imagine where you had 50 accounts. That's where they go. Make it look right. Okay? Hey, how you doing?
Man, good.
Good. All right. So anyway, this is some examples. Cash and cash equivalents, short-term investments. You got the idea of cash equivalents, right? 90 days or less. But really something that's the same as cash. Money market accounts or something. Short-term investments, and we like to use notes a lot. Why not? You can use notes or you can use the supporting schedule. I would use parenthetical if it's really short, right? Just on the face of the statement. Okay. Accounts receivable, and then in parentheses, less allowance for doubtful accounts. Okay? If it's very long, you can show the note here. See that? Note 2? And put it, put that there. That's an interesting one, too. A little story for you on that. For a while, it was kind of in vogue, the popular thing to do, right? Back when I was in public accounting, to not write the note down because it made the financial statement look kind of cluttered. So you wouldn't have note two there. You just assume people could go find the note. And I always thought, well, that's kind of obnoxious. I'd rather they told me which note it is because there's lots of notes. And I can find it really easy if they tell me the note. But okay, fine. The Parkers at Dwyer Building Closest is not. We don't want to say no. Okay, fine. Okay, sorry. We won't. And then I'll just tell my client when I'm sitting with them which note it was. And fine. Or the banker, whoever. What note. Doesn't matter. Anyway, then you describe what's going on in the note, of course. This is just part of it. They list stuff. And this stuff goes back to here, of course, right? Should show a total. Agrees with that, I would think. But anyway, I would prefer that. Don't have to. Anyway, we had this engagement where there were a couple things we were fighting over with the client about how we should disclose it or whether or not we should disclose it, or maybe we want to. And we were saying, no, you must disclose it, or we will not issue a statement. So, the thing you do, which is bad with hindsight, never thought this would happen. It's kind of bad. The last things you're working on are the last notes you wrote. Does that make sense? Because you wrote all the notes that were easy, where there was nothing contentious. And then these extra, we had two at the end, I think it was two, at the end that were the contentious stuff. And they were pretty long. They were about a page each or something, right? So they're the last couple. And we didn't have the note number stuff. So then what the client did, no kidding, the management of the client, they tore those pages out of the annual report we had printed up. So we printed up the annual report. It's their report, but we printed, it's a nice letterhead and all bound up and everything, and it's like a little book, right? But they really carefully pulled out the last couple pages in all the copies that they sent to all their stockholders into the bank. And then the banker called me and he says, Steve, we had a discussion about this stuff and there's no disclosures at all about it. Don't you think that should be there? And I said, no, that's note number such and such. I got my copy, so it's good. I said, no, it's in there. We didn't leave it out. It's right there. I knew it was there. It's there. He says, not my copy. I said, what? And he was like 5 blocks from me. I sprinted to his office to see him. And they were gone. So then I called up another stockholder, a major stockholder, asked if there was one there. No. So what do we have to do? We resigned the engagement. We got every single one of them back. And we reissued the statements with the notes in each of those people. And we disassociated ourselves from those engagements until they did what? Fired their financial vice president and their CEO, which came a few months later. They lost their job. So, I think we should write the note down. What do you think? I will never issue another financial statement without those figures. So, you would find back all this. Okay, I think it's easier to find them anyway. So, this little war story for you guys. So, anyways, fun stuff to run into that you wouldn't expect. All right, receivables. Major categories of receivables should be shown in the balance sheet, the related notes. Please separate current from non-current, anything? And we should show the anticipated loss due to uncollectibles. Oh, besides where those accounts go in the financial statements, what else could I ask you about? How do you value them? Are they valued at historical cost? Are they valued at fair market value? Are they valued, how's the receivable value? No, it's not. The receivable itself is historical, but what do we show on the balance sheet? A net receivable. And what's that called? Net realizable value, right? So it's historical cost less your allowance for doubtful accounts. So it's net realizable value, say that. Okay? So we could do this. Oh, we could do this with another alternative format question, right? Other alternative format question used on the CPA exam. They're kind of like multiple choice, except you'll have maybe 20 items that are listed, right? And you have to do an answer for each one of them. And then you'll have maybe 20 or 25 terms that you could use. And you can use the terms once, more than once, or never. Got the idea? So it turns multiple choice into a nightmare. Because you've got maybe 20 responses. You look at the question, I got to decide which of those 20 it is. And sometimes you can use more than one if you want. And there's all kinds of variations on this stuff just to make you pull your hair out, right? So basically, you have to really know what you're doing. In other words, it just makes it easier to grade. It would be just as easy for you if there was just a blank spot and you could write down what you want to, right? It'd probably be just as I'll give you both of those, right? I'll give you some alternative formats, I'll give you some multiple choices, and I'll give you a little blank spot, or I'll let you write a little short essay. We've already done a little bit of that, right? Anyway. And you know all the definitions are fair game too, of course. All right, anyway, so companies should clearly identify anticipated loss due to non-collectibles, of course, amount and nature of non-trade receivables, so keep trade separate. Oh, and we always show related party transactions separate. Because we assume the related party transactions are correctly recorded. If you're auditing, you try to make sure they are. But you want to record them properly, but you don't know whether or not it's an arm's length transaction. You know, if I hire my kid to work for my company, are they getting paid an appropriate wage, or might it be too high? Other shareholders are probably worried about too high, although with my dad it was always too low. That it was. They just didn't want anybody thinking we were getting special favors, so we made less than everybody else. So we got to work when we were pretty young too. So worked out, learned a lot, made some money. So anyway, partners would actually protect us from my father. Like Malone John, or I quit. Not us, them. Right? He didn't want them to quit. We couldn't, we were slaves. But anyway, well, maybe other place, yeah. So he didn't take our money, but let us keep our money. But anyway, why would you want to disclose that that's a related party? To hire your kid to the firm, the company's attorney, or you name it, right? The other shareholders, I don't know. That's all. If you loan your family members money, you loan affiliated companies money, you always tell everybody. Related party disclosures are really important. Okay? So anything that's related party, assets, liabilities, right? Minority interest, I guess, related party, even in equity. Think about it, right? And then also you have revenues, expenses, gains, or losses. Any transactions you're having with related parties, you always disclose. So you guys get that. And the receivables are used as collateral. If the receivables are tied with collateral, you can't borrow money from them, right? You can't factor them, which you're going to do real soon, which is sell them. You can't sell them, okay? You got to get money out of them that way. All right, cool. And here's some examples. Receivables, how they might do it. This is Stanley Black & Decker, okay? Real companies. So cash and cash equivalents, accounts and notes receivable net. And they just said net, so I would assume that somewhere they show us the net. Well, they do, don't they? Here's note B. Now, they didn't mention note B next to any of these. Could have. They chose not to. Accounting and financing, accounts and financing receivables. There's trade. That's with your customers, right? Trade accounts receivable, trade notes receivable. I guess you want to get a specific due date. If you want to get interest, maybe. That's why you have that. Other receivables. Gross amount of accounts and notes receivable, and they have allowance on all of them. So they've disclosed it in a note instead of parenthetically. That's just fine. It's okay. So just examples. Yes?
Would you possibly have like a note within a note for like the accounts receivable and tell them that you did like certain percent of it?
No. Okay. No. What I would do though, and we should mention that, the first note, sometimes it's note number one, sometimes there's no number on it. They just call it Summary of Significant Accounting Policies. Read about that? Right? The Summary of Significant Accounting Policies. In that note, you tell people where you make choices amongst different GAAP, right? So FIFO versus LIFO would be showed in that note. And then then you might have an inventory note, probably would, where you show numbers. What I like to do is, if there are numbers involved, specific things relating to this particular accounting period, where there are numbers involved, I like a separate note that's numbered 1, 2, 3, whatever. If it's a choice I'm making in terms of how I'm accounting for things, like the FIFO, LIFO, or the methods I'm using for depreciation, or you name it, right? Where I'm choosing amongst competing generally accepted accounting principles, I need to tell people which ones I use. That's supposed to go in the Summary of Significant Accounting Policies. So does that kind of answer that? Yeah. Yeah. And remember at the bottom of the statements, you always say in parentheses, the accompanying notes are an integral part of these financial statements. You must read the notes to understand the statements. So without the notes, you violated generally accepted accounting principles that are required. Okay? And different types of disclosures are required. And you'll gradually learn as we go through all this course where it's required, where it's not, that sort of thing. You can disclose anything you want in your notes as long as it's factual, right? But you usually don't disclose things that, well, you don't want to disclose anything the financial statement user doesn't need. That'd be information overload. There's too much already, right? And you want to make sure you disclose everything that's required, right? But you can disclose more than is required if you think that would be useful for them, right? Because it's usefulness is the criteria, right? Family statements. So all Yeah, here's things that you might disclose about inventory, and you can see the inventory is stated at lower of cost, first in, first out basis, or market there at the bottom on note 1. And that could be in the summary of significant counting policies, that information. But this detail here, notice they chose to on their current assets, this is Abbott Laboratories. On their current assets, they chose to show the 3 types of inventory they've got there because they're manufacturing drugs, right? Okay, is that what Abbott Laboratories does?
They do nutritional, mostly like pharmaceuticals.
Pharmaceutical, yeah. Okay. Anyway, yeah, and so vitamins and stuff, maybe, I don't know.
Yeah.
Okay. Anyway, so yeah, they could have done one line on the face of the balance sheet on their current assets. They could have one line for total inventories, and then in a note they could have shown the detail of that. But I wouldn't put that in the summary of significant accounting policies. I'd put that in a note related to inventory, and I'd label that note inventories. Don't you suppose? Okay. Good. Now you're excited about this, you guys. Okay. Did you guys know about deferrals and accruals? Are we tired of it? Yeah, we know about deferrals and accruals. Okay, so anyway, cash payment before the expense is recorded, of course, is a prepaid, right? And so is this a deferral or an accrual, by the way, for the expense? That's a deferral. You're putting the expense off until later, even though you paid for it now, right? That's a deferral. You don't defer the cash, you defer the expense. Okay, guys? Or you defer the revenue. What's deferred revenues called? Yeah, you guys thought too much about that. But unearned revenue, yeah, instantly. Okay, unearned revenue or deferred revenue. You use the word deferred revenue. What is that? What kind of account? This thing's an asset. What is deferred revenue or unearned revenue? It's a liability, sure. I own the goods or services. Okay, what's an accrued expense called? Accrued expenses. But what else? Typically a payable. Yeah, payable. Okay, sometimes. So salaries payable, payable, whatever it is. Sure. Okay, that's accrued. Right? And what's that? I have the expense before I pay for it. So I'm accruing. Yeah, what's an accrued revenue called? It's a receivable. Yeah, account receivable maybe. Okay, rent receivable. Whatever it is. Okay, got the idea? Interest receivable. Whatever you earn. Okay, so they have examples of prepayments. We know what prepayments are, but here's how you might disclose it. It's typically, these are in order of liquidity, aren't they, you guys? So I've got cash and other cash equivalents, accounts receivable less the allowance. That's parenthetical disclosure, even though they use parentheses. Everybody agree to that? And then we just show the net. Okay, or they could put it on 2 lines, or 3 lines, I guess it'd be. They have the receivables gross less the allowance, and then show that. Everybody got the idea? This is pretty flexible. Okay, this is real common to do it this way. And then inventories, but notice those are in the order of liquidity, right? Inventories will become receivables when you sell it, right? That asset, you get rid of that asset, you have the receivable. And then what? It converts to cash. So of course, it's an order of liquidity. Is this necessarily an order of liquidity? Nah. You might use up your prepaids before you sell your inventory. We don't care. This is usually, wow, it's usually a smaller number. This is a real company, Hasbro. Wow. Okay, anyway, this is usually pretty small. I think I would have separated prepaid expenses and find out what some of those other current assets are. What do you guys think? That's as big as their inventories. That's amazing. Okay. And their receivables are far bigger than their inventories. That's interesting for Hasbro. Although you can make their products really quickly, can't you? So why stockpile their money? Yeah, so maybe that's true. If you look at Walmart, what would it look like? Think Walmart. This is not really, it's big because they don't know what to do with all their cash because they're so rich. Okay, but anyway, yeah, this is pretty big, but not that big. This is amazingly big. Okay, I guess they're parking money in their cash equivalents. And these are real statements, I think, so that's amazing. Anyway, accounts receivable is really big compared to inventories, maybe because the inventories are turning. I would expect that number to be smaller, and I expect this to be smaller relative to the inventory. So that's interesting. Okay, so it's taking a while to collect. But it might depend on when their year end is, and if it's right after they did all their sales, which it probably is, they haven't collected from Christmas yet. Sadly. So it's going to be a real big number for a while, and then it might go down. So maybe it's normal for them. All this stuff we talk about, do those things occur to you when you look at a number? Not yet. I need to get you there, okay? So when you look at numbers, you know what you're looking at. The meeting I'm at today, we're looking at 60 or something nonprofit agencies that United Way and Little will give money. And we're going to look at their annual reports. We're going to look at their 990s, their tax return, and we're going to evaluate, read, and then give them advice. That's what we're supposed to do. So it's a committee of 8 people that are going to do this. So we're all looking at them. We're going to talk about it. And so what does that mean? Just read it. Right? Just read it. Look at it. Where are they at? What are they doing? How much debt do they have? How much, in their case, funds. broke, you know, can they pay their payroll? Just obvious things, right? Okay, some are real tiny nonprofits, some are huge. Salvation Army's on there, things like that. Red Cross is on there, you know, they have to give some funding. So I'm not too worried about those. They're pretty financially solid, but, and then some of them are real tiny. My comment to him was, how come KCEE isn't on there? Why don't we get any funding? They laughed at me. But anyway, yeah. Everybody must have it. Okay, anyway, so we got it, right? What's current, what's not current? Everybody good? No, we do. You know, current assets are. 1 year or one operating cycle, whichever is longer. Remember the one operating cycle. You'll get a CPA exam, multiple choice question, right? Maybe on my test. One of the responses is going to be, um, one of the responses will be 1 year, and you're going to be tempted, and another one will be 1 year or operating cycle, whichever is longer. Both are current assets and current liabilities, right? What do you mean by an operating cycle anyway? How long does it take you to go through the whole cycle? Buy the raw materials or whatever you're going to sell, right? Buy it, produce the product, deliver the product to the customer, pay for all those materials that came in, right? And get paid for your sale. So, and then you start over the whole cycle. Is that typically less than a year? How fast is it at McDonald's? Fast. How fast is it at Kroger? Pretty fast. How fast is it for the people building the bridge across the Ohio River? Oh, so if the project goes for more than a year, we arbitrarily separate it into years. So we say 1 year or operating cycle, whichever is longer, to determine whether it's current or non-current. Got it? So they were there, all right? Brilliant. Okay, anyway. Am I recording this?
Yes.
Oh, good. I actually started it. All right, anyway, non-current assets. Long-term investments, we got securities, bonds, common stock, long-term notes that we're going to hold for more than a year, right? On the bond, obviously, we're not holding it to maturity, or it would be called a maturity investment. Tangible fixed assets not currently used in operations, land held for speculation. Okay. If we give you a question that says they have land, building, equipment, and we're using it in our operations, you know, it's our warehouse, it's our office building, it's our equipment, delivery equipment, whatever, okay, manufacturing equipment. All that stuff is property, plant, and equipment. You show it, right? Well, by the way, how do you value that? Historical cost less what? Accumulated depreciation or amortization, if it's an amortizable asset, right? Okay, so, yeah, so we show that. But what if it's what if we take one of those assets, land, building, or equipment, we cease to use it, and now we're holding it for sale? Reclassify it, because it's not an operating asset, okay? You need to separate it out. And now how do you account for it? Probably at its last historical cost, okay? Sometimes at market value, okay? Got it? So just say it at its depreciated value, but you stop depreciating it. Does that make sense? Okay, because you're not using it anymore. Why would you depreciate it? Depreciation is supposed to be reflecting using it up, the cost of using it up. Okay, so not currently used in operation, land held for speculation, for instance. It's kind of like an investment, isn't it? Special funds. What's a sinking fund, you guys? There's a lot here, isn't there? What's a sinking fund? I have a bond. Oh, a lot of money on the bond, billions of dollars. Part of the bond agreement says that I have to set money aside to pay off the bond. You're not making payments on the bond. It's not a serial bond, but you're making payments, okay? What it is you put the money into investments, called a sinking fund, right? You put the money into the investments, and then the earnings off of that, interest and dividends, right, off of those investments, are what? Income to you, right? It's your income. It's not the people you owe the money to. Then when the bond is due, right, you use that sinking fund to pay them. What if there's not enough money in the sinking fund to pay the principal plus interest? There'll be enough for the principal, but there might not be enough for interest if you don't earn enough. If you got the idea, what do? You put in more, pony up more and pay it, right? That's it. You have to pay the whole thing. What if there's more than enough to pay them? You keep it. It's yours. Got it? So this is your asset, okay, sinking fund. Pension funds the same way, okay, funded by the companies. Plan expansion fund, I'm actually, now this is not just appropriated retained earnings. This is setting money aside, right? It's setting money aside for building a new plant or something. So the cash is restricted for that purpose. Got the idea? Okay, so plant expansion fund, and then any interest on that would, of course, go towards building the plant. And cash surrender value life insurance, What this is you have life insurance, maybe the president of the company, top officers anyway. If they were to die, I don't know, it's Bill Gates, right? If they were to die, what happens to the profitability of the company? What happens to the stock value? They're just gone suddenly. So say it's a top employee, somebody really critically important to you, right? You really need them. And sometimes they can be people that are creative people, right? Not necessarily the CEO. Be creative people that you really need. Okay, so if you lose them with the guy, the insurance gets paid to the company, and the company uses the insurance to get themselves stable again, hire somebody else, do all that sort of thing. And that money that you get from the insurance policy does not get taxed to the company. But here's the deal. All of your insurance premiums that you pay on that policy, the policy's in the company name, they're the beneficiary, but it's on the life of an employee. Got the idea? All the premiums you pay you can't deduct. So it's a nice little thing, because the premium's relatively small, and you do it every year, right? So you don't get to deduct that in your tax return, but then if the policy ever pays off, you ever get the money from it, right? Then that's not taxable, right? Kind of a nice little thing. The tax code helps out. Good thing. Good, I think, on that one. What the cash surrender value is when you're making these insurance premium payments, they take the money and invest it, right? You put the premiums that you pay, and it will grow a cash value on whole life insurance for your entire life term, right? So as that value grows, that belongs to the company. Just like if you're an individual and bought a policy on yourself, where your kids get to be the beneficiaries. As it grows, it's not a good investment. It doesn't earn much, but at least you get something, right? And you got the insurance too. And so that cash surrender value is an asset of the company. Make sense? It's there. They're going to get it. Okay. So, all right. They're not going to give it to the employee. Okay, and then non-consolidated subsidiaries or affiliated companies. What's another name? What's the method of accounting we use with an affiliate? And what's the percentage ownership with an affiliate? Yeah, more than 20, so you have significant influence, up to 50, so you don't have control. If you go about 50, you've got control. Now what would be a non-consolidated subsidiary? For some reason you don't consolidate them, right? You're not running them. That's the idea there. So if you can prove that somebody else runs them, even though you own more than 50%, you don't consolidate. So those are the other assets you have. Make sense? Good stuff. All right. And guess what? These are exactly the same things, aren't they? That we had in the current assets. Held to maturity debt. Held to maturity debt would be current at what? If the maturity is what? Less than a year operating cycle from now. Trading is always current. Why? It's going to be a couple of weeks. Available for sale could be current or non-current, right? We already talked about that. So this could be investments in debt and or equity, right? For trading and available for sale. So depends on how long you're going to hold it. That's all. Right? So here's an example. Okay, they've got investments, ABC bonds, UCE, all right, notes receivable, land held for speculation, sinking fund pension, I think all kinds of stuff. Cash surrender value, investment in unconsolidated sub, fine. Okay? Depends on your intent. Land held for speculation, those. Non-consolidated subsidiaries and affiliated companies, call them an affiliate. Okay. You remember the method of accounting that you use if it's an affiliate? Equity. What method of accounting are you using if it's an investment in a trading security or available for sale short-term or long-term? Market value method. And adjust it to market earnings. Market. Okay. What kind of method of accounting are you going to use if you own more than 50%? We're going to consolidate. Okay. Consolidate and make it all in one company. Got it. Okay. Good, guys. Okay. On a bond, held to maturity, classified as bond held to maturity. A bond held for less than maturity but more than a year. Available for sale long term. Less than a year. Available for sale short term. Only a couple months on a bond. Trading security. Got it? It's your intent. Okay. So and here's another one. Motorola and millions. They got it. So, right.
Is non-consolidated subsidiaries common?
consolidate if you have an agreement where somebody else wants to get anything to do with it. And you, by the way, you probably set it up like that on purpose, right? So
And it's like a few other
companies that they don't
run, like long
they-
on silver.
yeah, they call them consolidated subsidiary. They're still a subsidiary. They were running them. They were together. They what's funny about Yum is they were once called Tricon, and Tricon was the three that they now only have three again, don't they? Yeah, I think it was the same three. Pizza Hut, KFC, and Taco Bell. Yeah, but then they got Long John Silver's and A&W, so they had five, so they couldn't be Tricon anymore. Be careful what your name is, right? They didn't like Tricon because they were five of them. Didn't make any sense. They thought so. Yeah, whatever.
We did parodies
So
of it.
Yum's kind of nice. Yeah. But Yum's kind of nice for a food company, don't you think? I think they need a store named Yum. You know, what should they sell? How about something healthy? Don't tell anybody at work. I did a professor at Bellarmine would say something like that about a great Louisville company. Yeah, great Kentucky company. We love them. Actually, they're great. They're good. Just don't consume too much of their products. Anyway, okay. Jeez, I guess we're okay. You guys are moving around too much. You make me think we're leaving or something. We don't want to leave it, do we?
No.
Oh, hell no. What do we do? We don't have lives that are counts. Okay, property, plant, and equipment. Tangible, long-lived assets used in the regular operations. I mentioned this, right? These are the operating assets, okay? Physical property, land, building, machinery, equipment, furniture, tools, and wasting resources like minerals, right? You own a coal mine or something. Okay, got the idea? Oil. With the exception of land, a company either depreciates the buildings or depletes it. Oil reserves, these assets. Absolutely, we do that. Oil reserves, whatever. Okay, so here's the disclosure of what it would look like. So you can see property, plant, and equipment comes after the current assets, before intangible assets, before other assets. Other is sort of a catch-all where we put things. Okay, and you can see accumulated depreciation. That's one way you could do it. You know, you could do the detail in a note to the financial statement and just have one or two lines here. You could show in parentheses less accumulated depreciation, you know, and just show the total. You know, all kinds of ways you can do this. Okay? You could do a supporting schedule for property, plant, and equipment, because there's quite a few of them here, huh? You could show depreciation on machinery and equipment, and then on capital leases, and then on leasehold improvements separate, right? You could have several different accumulated depreciation. Doesn't matter. Okay? Here's another example, and you can see down here, separated out. And this is right on the face of their balance sheet from Mattel, right? Land, building, machinery, equipment, capitalized leases, leasehold improvements. And then capitalized leases, I'm leasing the building, but I'm leasing it for most of its life. There are rules associated with that, and we'll do that in 212 also for leasing. And so the capitalized leases it's the same as though we're buying the building, okay, or equipment. And then leasehold improvements is, have you ever seen a mall while they're building it? They're concrete boxes. You know, any of the malls here in Louisville, you know, the big ones, right? They're just concrete boxes. It's really dark in there. They're kind of cool. Anyway, they're just concrete boxes. And what you lease is a concrete box, right? I mean, everything's, except they do all the hallways and everything the mall builds, and the mall owns that. And of course, you're paying rent, you know, and so on it, that's included in it. But your facility, you do everything. It's just a concrete box, and you put in, I mean, everything. All the lighting, all the flooring, all the displays, everything. And that's called leasehold improvements. And you know what? We amortize it over the term of the lease. Why? That's all you own. When the lease is done, guess what? You leave that stuff and go away, right? Of course, somebody else is going to gut it out and make their own store out of it. Right? They're going to be worn out. So you notice how often they change, even if it stays the same store, they're constantly refurbishing that stuff. They want to look new and cool and, you know, get people in. Yeah, I stuff. I remember they used to do it that way. I try not to go to malls. So they don't have to. I don't know why malls exist. Don't they know about buying online? Did you buy anything you want online? I am wearing a suit. I bet you anything my wife, no, she might have bought it at the store, but I wasn't there. Right? You know, what's like that? And she orders stuff online, and you can send it back if you want. You know, they're fast and going, why do we have stores still? Because people like to go to the store. Oh, yeah. Okay, so there's an example. Intangible assets, they would come next after the plant and equipment, property, plant and equipment. Keep them in their order, and then just sort of a stuff. And they're usually intangibles, huh? Goodwill, That's all purchased goodwill, right? Paths that we purchased, not that we developed ourselves. We don't have any value for those. We get it out there. Okay, trademarks, anything you got that's intangible. Now they've added the other assets down here. Got a couple others. So limited life and indefinite life. The indefinite life is goodwill. We test it for impairment every year, and we write it down if we need to. We never write it up. Okay, so we get actuaries involved in doing that. And then the limited life intangibles, the amortizable, whatever their life is, which is all the rest of them, patent, trademark, whatever. Okay. So here's an illustration. I want you to do this section. That's lovely. Okay. Waste of time. Okay. Anyway, so intangible assets. Here's an example: Pepsi, right? Goodwill, trademarks, other identifiable, and they show their total. Notice we call things others. There's not very much of it. That earlier one where they called it other, and what was it, prepaids and other. I don't like that very well. You can't tell what it is, and it's too big a number. Who cares what these other intangibles are? It's 147 million out of 4.8 billion. Fine, right? There's a bunch of stuff probably. That's okay. That's all right. So use your judgment there. That amount's probably material for them anyway. Okay, but you still got to disclose it. You want the totals to agree.
So you would have to disclose what's actually in those.
Nah, you don't have to talk about it. It's too small to worry about. Okay, and the other ones they told us, didn't they? They were. Yeah. Okay. Items vary in practice for other assets, but you might have long-term prepaids, you might have non-current receivables down there. Assets you put in special funds, like for plant expansion. They gave an example. Deferred income tax. Yeah, this is a deferred income tax receivable, okay, but it's non-current. You know what? You can have a deferred income tax receivable that's current, go into current assets. What does that mean? It's going to reverse in the next year, right? You're going to pay the year. No, you're going to have the tax reduction. Okay, so that. By the way, you don't really like deferred tax assets. Why? It means you paid your taxes early. Deferred tax liability means we're going to pay later, right? But if the law requires you to pay early, you might be receiving advance payments from your customers, so it's really unearned revenue on your income statement, but it might be taxable for tax purposes, okay? Depending on what it is, okay? So you'll end up in those situations. So you're going to have a current deferred tax asset, or you could have a non-current deferred tax asset, right? Or both. You could also have a current deferred tax liability that's going to reverse the next year, or a non-current deferred tax liability. So you might see those, okay? All four are possible. Anyway, property held for sale would be separately classified, restricted cash or securities perhaps. So a variety of things. So there's how they do the other asset trading. Okay, and then we're on liabilities in most sector. Okay, page 38. Another day talking about this, and then we got a review. We don't have a whole day. How many are there reviews? See all the slides. There are. There are 98 of them, but a bunch of them are just examples of financial statements. There's 77. Yeah, we'll spend another day on this, and then we'll do our review. I guess we will do the review. We are. There's some stuff to crank through. And then the statement of cash flows. In that review, maybe we'll do a statement of cash flows too.